is Giannis Andreou, and today we're going to explore a case study between a prime lender or A lender, a B lender and a private lender to see under what circumstances an applicant would qualify with one of the three. We are going to assume a $600,000 mortgage amount, and starting with the interest rate, an A lender can offer us on the variable side 2.9% right now, a B lender 4.95%, and a private lender 8.95%. A monthly payment will be for the $600,000 mortgage amount $2,491.80, for the B lender $3,184.26, and for the private lender $4,736.30. In terms of the prepayment privilege, we have 20% per year from the A lender and from the B lender, and it's fully open for prepayment at any time from the private lender as long as you select the right private lender that doesn't have a penalty. That is key. The term is a 5-year variable for the for the A lender, 5-year variable for the B lender, 1-year line of credit fully open for the private lender. In terms of the penalty, after assuming that we have 57 months remaining on the mortgage, that would be for the A lender $4,326 because it's interest only for 3 months, $12,375 for the B lender, so it's pretty steep, and $0 for the private lender, again, as long as you select the right private lender. Not all apples are created equal. Now, in terms of the lender fee, it is 0% for the A lender, 0 to 1% on the B lender, the client has the option to select that, and between, I would say, 2 to 2.5% for the private lender. And the best private lenders will not charge you renewal fee. So if you pay an upfront fee that is higher, it's well worth it. In terms of the loan to value, we have taken a case in which we have a 25% down payment. The credit score for the A lender is 750, for the B lender is 645, and for the private lender is 425 on a credit scale of 300 to 900, where any score under 600 is below average and very weak. So 425 is really bottom of the barrel material, and that's why we can go to A lenders or B lenders in this case. The broker fee is 0% for an A lender, between 0.5% to 1% through the B lender, and that is basically on top of the lender referral fee for a 1 to 2 year term. And then for the private lender, it's usually 1.5% of the mortgage amount. In terms of the renewal fee, 0% for the A lender, 0% for the B lender, 0% for the private lender, as long as the right private lender again is selected. Because some private lenders may say, okay, we will charge you a 1% lender fee at the beginning, but then every year you go back to renew, you have an additional 1% renewal fee on the whole mortgage amount. So you really have to be cautious when you select the private lender. In terms of credit history, the A lender wants to have a perfect history, maybe a payment that is 1 month old. In terms of the B lender, they are okay with everything that is a blemish in the past, like collections, judgments, bankruptcies, consumer proposals, as long as you have been discharged for at least a few months. In terms of the private lender, assuming that we are about to be discharged from the bankruptcy and the consumer proposal, and we are currently in bankruptcy or consumer proposal, the private lenders are fine with it. And that's the beauty of using a private lender. It's a short-term bridge solution for 1 to 2 years to help you reclaim your credit history, and then you can make the jump first to a B lender and then to an A lender. That is a traditional, logical process. 1 to 2 years with a private lender, then 1 year with a B lender, and then after approximately 3 years with an A lender. That is the logical sequence of steps. As you can see here, each option has a different set of items that need to be met, and characteristics and qualifications by the lender. Hopefully this information helps you understand better how A lenders, B lenders and private lenders differ, and where they come into play in terms of a mortgage solution. If you found this information useful and helpful, feel free to share it with a friend. Thank you for your time and have a wonderful day.